Okay, so I just want to keep this dirt simple. We're just going to start with market structure. What does the market structure look like? So generally what I want you to focus on, and I want you to focus on one simple movement, technically three movements, but it's in either one direction. So what you're looking for is an impulse up, a small pullback that doesn't break the where it started from. So it can pull back anywhere within here. Generally, I like to see about halfway between, and then a impulse up. That to me is the start of an uptrend. From here, I'm looking for buys. In the reverse area, you'd start up here, pull back, go down, pull back, and then break that there. The key element here is this is the high, this is the higher low, this is the higher high. So whenever you have particular trends, you have the low here, you have the high here, you have the higher low, and then this completes with a higher high. So that is the basically breakdown of what an uptrend is. You have higher highs and higher lows, and it continuously going. That's what you get for an uptrend. Downtrend, flip that, reverse that, however you want to think about it. Who cares? Just it's the same concept, just going in the opposite direction. Now, we won't know once we have a low and we have a high and price starts pulling back. We won't know when this higher low is created until price actually breaks this high that was here and creates a higher high. Once we have that, then we have a higher low that's created, wherever it was. It could come all the way down here. It could come up short. It could do whatever it wants in this entire time. But once I have this move, I have what I start to look at as being an uptrend. From here, I'm only looking for buys. I'm not looking for anything else. And so that's basically what you want to start with, is looking for these price movements and seeing how the price reacts. So we have things like, if we started here, we have a low, came up to create this high right here, pulled all the way back here. Now, you could consider this a break because it actually did go higher. You could. And so that would be that. And it would be a pullback here. And then finally another break here before whatever you want to call pullbacks and a complete, whatever, another high there. So at the beginning part of this would have been an uptrend that I was looking for. If I was looking at the market at this point in time, I'm not really paying attention to all this because this has been a downtrend. And this would be, like if I'm on the daily, this is back in June. I'm looking at like recent data, what's going on recently. And so recently, this is what we have. We have this uptrend that's been going on. And so I'd only be looking for buys. I'd be looking at this particular area here. To me, this is still the same area. It just didn't break it until you actually got to this point right here. So I would actually be looking at that as the final break. Once you have that final break there, I'm looking at the areas that I want you to look at are the highs that were previously broken. So like this was the high that was broken. What happens when price comes back in that area? Does it generally continuously move in the same direction as the uptrend that I started or that I saw, or does it do something different? That's where you get into the market and start looking at some of these things. Now, you can start this from anywhere, and there's no wrong way to do it. This is the key is not trying to be right or wrong. The key is just trying to find opportunities that you can use to get into the market that give you an area on the chart that you can look at and go, okay, if price does not do what I want it to do, here's where I know I'm dead wrong. Here's where price is less likely to do exactly what I want it to do based upon how market structure moves. And so if you were to start, all the way, if you wanted to start all the way back here and just let's trace out how the market's moved. Okay. So we have nothing. We had a low that was created, it went up to a high, and then we have an equal low, nothing. Okay, well, now we have something. Now we're starting to go somewhere because we have a high that is higher than its previous high. So now I'd be looking for buys. What does that look like? Well, you look for particular areas where this was the high that was created. Price came back in here, did some funky stuff before finally going higher. So this is just showing you, yeah, that once you start getting into a trend of some sort, it generally consists and goes that way until it's broken. So price pulls back, breaks up again. We now have same thing. We now have another high that was created right here. When price pulls back into this area here, it doesn't respect that. But price also does not break below the low that created this high. And so the uptrend is still intact. We will look at what just happened there. Stop that. Why are you? What the heck did you just do? Good gracious. Okay. We will look at when you have an uptrend, you will generally continue making highs, higher lows, all the way up. And we consider this still a valid uptrend. It could pull all the way back to that low and continue going up. It could pull all the way back to that low and continue going up. It could pull all the way back again and continue going up. It could pull all the way back. It's still a valid uptrend until the low that created the high, which once again, you don't know that this is the higher low until that higher high is created. You didn't know that this was the higher low until this higher high was created. Once you've established this higher low, that is the reference point for the trend. The trend remains intact as long as it does not violate that. As soon as you get a new reference point, price breaks up. As long as price stays above this area here, we're still considered an uptrend. Same here. As long as price stays above this area here, we're still considered an uptrend. Continue going all the way up, we'll continue going here. Price made this higher high, that's the higher low. Price did not violate and close below this area, so we're still good. This is still a valid uptrend. Now, this might signal that it's getting weaker. We had these strong impulses all the way up. It never pulled back fully, but now all of a sudden it has. Could be indication it's getting weaker. We have this right here. Price broke up. We have a higher low that was created. We finally got into a higher high. This is the low that created that high. Okay, we're good there. Comes back. Same thing. We're still good. So this entire time, this is still considered an uptrend, and I'm putting air quotes in the air right now because given this looks more convincing of an uptrend. This is starting to get a little bit iffy. If you were to put money on whether or not, if the market was moving like this and you came to the market and price was coming into this area right here and you found a reason to get in, would you be more willing to get into something like this where you're targeting a higher high, or would you be more willing to get into something where price has gone up, but you're not exactly sure if it's going to get up again? Because you never know when price might not make it all the way up. Maybe it pauses down here. Maybe this never made it that high and it came down here. All these are still valid. So even if it bounced right here, like all this is still valid, but it's no longer showing a strong uptrend. And so you just got to watch out for things like that. So there are these 1, 2, 3 moves, which is I would like for you to be able to describe your own moves by yourself, because the better you can use your own terminology to describe what you're looking at, the easier it will be for you to understand what you're looking at. And it doesn't have to be like the nomenclature doesn't matter, whether you call it an uptrend, whether you call it bullish movement, whether you call it uh, good gracious, support, resistance, a floor, a ceiling, supply, demand, no matter what you call it, it doesn't really change how it operates, how the market actually moves. So you can call whatever you want. Um, you can call this your brick wall. That if price is in an uptrend, you don't want to see anybody break through this brick wall. And as long as price stays above this brick wall, then you're taking buys all day long. And so, I mean, you can call it whatever you want. So come to the market, and what I want you to look at is how the market actually moves. And so what you'll notice is, yeah, the market tends to move in these not necessarily, sporadic movements, but there is a movement type to them that the more you look at it, the more it starts to make sense. So that is this. That's an uptrend. You have the low that created this high up here, that price came all the way back to it before finally taking up, then created a new low that was only validated once you had the high, but then price came back to it and then shot off. So it's like there are these opportunities, and what we're looking for these areas here. The previous high that was broken, as well as the last low that created the high, because those are two areas that are generally well respected. And two areas we can look for opportunities to possibly get into a trade. Now, I said earlier, we're only using this as a means to tell us when we're wrong. So if an uptrend is going to continue, then we know that the previous low cannot be broken. And so we can basically say, I can take a trade anywhere after price moves away from this area here, and I could have my invalidation, my stop loss, the decision where I'm going to get out a little bit below this area, to say, okay, if price happens to make it below this area, I'm more than likely wrong. And then that's it. You just place the trades. You're finding areas. You're basically trying to find interest areas that you can know whether or not that you'll be able to figure out whether or not, if you were to get into a trade, where could you cut it off as being lost? Where could you cut it off as being like, this is where I would get out because I'm obviously wrong, as well as the other side where it's like, if price is going to go in this other direction, about where would it go for me to be able to go ahead and get out? And so using this should start somewhere around here, is about a 50-50 win rate, which is perfect. But you don't need anything higher than that. Because what we'll end up doing is, as you get into the markets, you'll build your intuition, you'll build your skill set that'll be able to allow you to know, or have a higher probability of feeling that price is going to continue in one particular direction, so you can hold your trades longer. So if you're going for a 1-to-1 and with a 50% win rate, that means you're pretty much break even for your entire trading career. That's great. But if you could just find ways to get even 1.1 out of the market at a 50% win rate, that's profitable. 1.2 at a 50% win rate, that's profitable. It works out even better is if you can get into a particular trade, and if it starts going against you, you cut out your trades early. So maybe majority of your 50% win rate trades go to 1-to-1 and you hit your take profit. Whereas your losses, you end up cutting early, maybe at like an 80-60% loss instead of a full 100% loss. And so that's another way to increase your profitability. So start out with just looking at the way the market moves. I'm going to cut this out right now, and then I'm going to get to setting up TradingView. That way, because I realize you've been using stuff through Coinbase. Let's get on TradingView and go there.